The great liquidity shift, where smart money is hiding. Look at the headlines today, and you'll see a paradox that almost no one is truly explaining. Stock markets are breaking all-time highs. Real estate in major cities remains priced far beyond reach. If you only look at surface-level indicators, the Dow Jones, the S&P 500, nominal GDP, it feels like we are living in a golden age, an era of unprecedented prosperity. But step away from the screens, step away from the charts, and ask the average person how the economy actually feels. You'll hear a very different story. The middle class is being hollowed out, savings are quietly disappearing, and the cost of capital has fundamentally changed. Welcome back to Market Decoded. Today, we're pulling back the curtain on one of the greatest financial illusions of our time, the phantom economy. To truly understand this disconnect, we need to change how we measure wealth. Stop looking at nominal numbers, start looking at purchasing power. Because the truth is, your money isn't just losing value, it's leaking, silently, continuously. For decades, we've been conditioned to believe that inflation is just a mild tax, 2% a year, a small, acceptable cost, in exchange for economic growth. But what happens when the very definition of inflation is engineered to hide the truth? Since the abandonment of the gold standard in 1971, the global financial system has been operating on pure fiat, currency backed by nothing but faith and credit. And over the past 4 years, that faith has been tested like never before. We witnessed an expansion of the M2 money supply on a scale that history has never seen. Trillions of dollars created out of thin air, summoned into existence with a few keystrokes. Now understand this clearly. When you increase the supply of money faster than the production of real goods and services, that currency doesn't stay the same. It dilutes. Its value quietly erodes. Which leads us to a critical realization. The stock market isn't necessarily going up because companies have suddenly become more productive, more efficient, or more valuable. It's going up because the currency used to price those companies is worth less. What you're witnessing is not pure wealth creation. It's asset price inflation, disguised as prosperity. And this is where the line is drawn. If you own hard assets, equities, real estate, commodities, you are on the receiving end of this shift. But if you don't, if you're holding only cash, then whether you realize it or not, you are standing on the wrong side of the greatest wealth transfer of our time. The sovereign debt trap, the math that cannot be fixed. Which brings us to the elephant in the room. The only reason this entire illusion was able to persist for so long was because of one key mechanism: zero interest rate policy, ZIRP. For years, money was essentially free. Borrowing carried almost no cost, and so governments borrowed, corporations borrowed, consumers borrowed, everyone gorged on cheap debt. But that era is over, definitively over, and now the consequences are beginning to surface. What we are entering is what economists call the sovereign debt trap. Let's take the United States as the primary example, though in reality, this pattern applies to nearly every major developed economy. U.S. national debt is growing at a pace that is almost difficult to comprehend, roughly $1 trillion added every 100 days. But here's the key insight. The total debt itself is not the immediate crisis. It's the interest on that debt. Because in order to fight inflation, the very inflation created by years of easy money, central banks were forced to raise interest rates aggressively. And when rates rise, the cost of servicing that massive debt explodes. What was once manageable becomes suffocating. And this is where the trap closes, because governments now face an impossible choice: raise rates and crush the system under the weight of interest payments, or lower rates, and risk reigniting the very inflation they tried to contain. There is no clean exit, no painless solution, only trade-offs and consequences. And that is why this isn't just an economic cycle. This is a structural turning point, a moment where the rules of the game begin to change. A mathematical inflection point. The moment a government is forced to borrow money just to pay the interest on the money it has already borrowed, that is when the system crosses a line into a debt spiral. And once that spiral begins, it feeds on itself. Now the question becomes, how does a government escape? History gives us only 3 paths, and none of them are easy. Option 1, austerity and massive tax increases. Cut spending, raise taxes, force the system to deleverage. But in reality, this is political suicide. No government survives long enough to fully execute it. Option 2, default. Refuse to pay the debt, restructure the system. But this path would trigger a global shockwave, a collapse of confidence, a depression on a scale few are prepared to face. And so we arrive at option 3, the only option that has ever been consistently chosen. Financial repression and inflation, not loud, not obvious, but gradual. Persistent, they will devalue the currency, slowly but deliberately, melting away the real burden of debt over time. This is not a policy mistake. It is not poor management. It is a mathematical necessity. The system is designed to inflate, and the world is beginning to understand this, which is why we are now witnessing one of the most significant financial shifts in modern history, a shift not seen since Bretton Woods in 1944, the rise of de-dollarization. For over half a century, the US dollar has held a unique position, the world's reserve currency, oil priced in dollars, global trade settled in dollars, an exorbitant privilege that gave the United States immense power. But that power has also been used. And in recent geopolitical conflicts, the dollar-based financial system, particularly the SWIFT network, was weaponized, sending a very clear message to the rest of the world, especially to nations in the global South and the East. A message that cannot be ignored. If you don't hold the asset physically, then you don't truly own it. Look at what the smart money at the sovereign level is doing. Over the past 2 years, global central banks have been buying physical gold at a pace not seen since the 1960s. And this is important. They are not buying paper gold, not ETFs. They are demanding physical delivery, real gold. And they are bringing it home, repatriating it into their own sovereign vaults. China, Russia, India, and central banks across the Middle East are all moving in the same direction, aggressively reducing exposure to US treasuries. This is not random. This is preparation. Preparation for a new financial world, a multipolar system where no single currency dominates, where trade is no longer settled exclusively in US dollars, but increasingly in local currencies, backed not just by trust, but by commodities, by real assets. And in that world, gold reclaims its historical role, a Tier 1 asset, zero counterparty risk, no promises, no liabilities, just value in its purest form. And if you are not paying attention to what central banks are doing right now, then you are missing one of the most important macro signals of this entire decade. But while all of this is happening beneath the surface, the spotlight at the retail level is fixed on something else entirely. Artificial intelligence. The promise of AI has driven markets higher, pushed global indices to new highs, created a narrative of endless growth. But behind that rally, there is a vulnerability, a fragile foundation that very few are talking about. Because what we are witnessing right now is the highest level of market concentration in modern financial history. A small number of companies carrying the weight of the entire market. And when concentration reaches extremes, it doesn't eliminate risk, it hides it. Until one day, it doesn't. Just a handful of mega-cap tech stocks are carrying the entire weight of the market. This is not a broad-based economic expansion. It's not a healthy, diversified growth cycle. What we are witnessing is a hyper-concentrated flight of capital into a very small group of perceived safe growth assets. And at the same time, passive investing has been quietly amplifying this effect. Trillions of dollars flowing automatically into index funds, blindly allocating capital into the largest companies, regardless of valuation, regardless of fundamentals. It creates a feedback loop. Prices go up because money flows in, and money flows in because prices go up, self-reinforcing, self-justifying, until one day it isn't. And this leads us to the most important question that every Market Decoded viewer needs to ask. Are we actually pricing in real productivity gains? Or are we pricing in the hype of a new paradigm? Because yes, artificial intelligence will change the world. It will transform logistics, revolutionize medicine, redefine how code is written and how businesses operate. There is no doubt about that. But here's the part the market is choosing to ignore. The companies building this future, the chip manufacturers, the data center operators, the energy infrastructure providers, they require enormous capital, massive upfront investment, billions upon billions before returns are ever realized. And if the adoption curve of AI does not grow fast enough to justify that level of investment, then the gap between expectation and reality will begin to widen. And when that gap becomes too large, the market doesn't adjust slowly. It corrects violently. Explosive valuations, already priced into these stocks, have created a fragile environment because when expectations run too far ahead of reality, the market becomes vulnerable to something inevitable, mean reversion. This is a classic pick and shovel play, but right now, the shovels are priced as if every single miner will strike gold tomorrow. And history has shown us that rarely happens. So take a step back and look at the full picture. We have a system addicted to debt, inflation, not as a risk, but as a mathematical certainty, a geopolitical shift gradually moving away from the US dollar, and a stock market concentrated in just a handful of tech giants. So the real question becomes, how do you protect your wealth? And more importantly, how do you position yourself to benefit from what comes next? This is the Market Decoded playbook. First, you must own hard assets. In an era where fiat currency is continuously being debased, you want to hold things that cannot be printed. Assets that exist outside the promises of governments and beyond the balance sheets of corporations. Physical real estate in regions with strong demographic growth, commodities that the world depends on, and physical gold, a timeless store of value. These are your anchors. They don't rely on trust. They don't depend on policy. Their value is intrinsic. And in a world of uncertainty, that is exactly what you need. Second, prioritize cash flow over speculation. The era of buying into a company with no profits and hoping someone else will pay a higher price later, that era is over. The cost of capital is no longer cheap, money is no longer free, and in this environment, only one thing truly matters: real cash flow, consistent, reliable, and adjusted for inflation. You want assets, you want businesses that generate income today, not promises of income sometime in the future. Because in a high-rate world, survival belongs to those who can sustain themselves, and pricing power becomes the ultimate shield. The ability to raise prices without losing demand is what protects value when everything else is being eroded by inflation. Third, the barbell strategy, a structure built for uncertainty. On one end of the barbell, you stay defensive, extremely safe, highly liquid, cash or short-term treasuries, capital that is ready, waiting. So that when opportunities appear, when markets correct, when assets go on sale, you have the ability to act decisively, without hesitation. And on the other end, you take calculated risk, a small portion of your portfolio allocated to asymmetric opportunities, high risk, but even higher potential reward. This could be Bitcoin, a digital asset outside the control of any single government, a hedge against the traditional system. Or it could be strategic exposure to the raw materials powering the future. Copper, uranium, rare earth metals, the building blocks of AI infrastructure, and the global energy transition. This is not about gambling, it's about positioning, because in times of structural change, the biggest opportunities always exist at the extremes. We are not entering an apocalypse. We are entering a transfer of wealth, because wealth is never destroyed. It doesn't disappear. It simply changes hands. It moves from the uninformed to the prepared, from those holding melting fiat to those holding scarce real assets. The signals, they're already here. The patterns, they've happened before. The 60-year cycles are not theory. They are repeating in real time. The only question is, are you paying attention? Are you reading the signals, or are you reacting to the noise? Because in times like this, clarity becomes your greatest advantage, and positioning becomes everything. If this deep dive has changed the way you look at the markets, then take a moment, hit the like button, subscribe to the channel, and share this video, because every action like that tells the algorithm that real analysis still matters, that depth still has value. Until next time, keep decoding the noise.